The golden age of America begins right now. We will be the envy of every nation. I will very simply put America first.
Brian, that's right. This report always is our best look at the tariff revenue. But first, top line here, it was a big deficit month for the U.S. Treasury.
Imagine a world where no one wants to buy US debt anymore. No China, no Japan, not even American investors. What happens next? Before we talk about what happens next, if the world stops buying US debt, let's understand what US debt is and how it works. The United States government, just like a regular household, has income and expenses. It collects money mainly through taxes. But for over 20 years now, the government has been spending more money than it earns. That gap between spending and income is called a budget deficit. To cover this gap, the government borrows money. And how does it borrow? Through something called Treasury securities, also known as bonds. When you buy a bond, you're lending money to the US government. In return, the government promises to pay you back later with interest. These bonds are sold to banks, pension funds, private investors, and even other countries. Countries like Japan and China have historically been among the largest foreign holders of US debt. The US Treasury sells these bonds at regular auctions. Investors, both in the US and around the world, would buy them with full confidence they'd be paid back with interest. And as long as there are enough buyers, everything runs smoothly. As of early 2025, the total US national debt stands at a staggering $36.22 trillion. That's more than the combined economies of Europe, Africa, and South America. Of that amount, around $8 trillion is held by foreign countries, including major economies like China and Japan. So why invest so heavily in US debt? One word: safety. US Treasury bonds are considered one of the safest investments on the planet. While stocks can crash and companies can go bankrupt, a government, especially one as stable as the US, is far less likely to default. For pension funds, central banks, and sovereign wealth funds managing taxpayer money, safety is the top priority. Another reason is liquidity. US bonds are easy to buy and sell, making them a reliable place to park large sums of money. And because the US dollar is the world's reserve currency, holding US debt also helps stabilize foreign currencies and support global trade. Even during times of crisis, the US has never defaulted on its debt, so it's stable and reliable. But things have started to shift. This massive borrowing comes with consequences. The US now pays over $1 trillion every year just in interest. That breaks down to $3 billion per day, simply to keep up with the debt, before even touching the principal. Even during the 2008 financial crisis, to avoid collapse, the US government spent over $1.5 trillion on emergency bailouts and stimulus packages. All of that went on the country's credit card. Then came the COVID-19 pandemic, and another $5 trillion in spending was added. From 2008 to now, US debt has tripled, and with interest rates on the rise, these payments will continue to climb. What makes this even more worrying is the shift in global sentiment. Since 2021, China has sold off over $340 billion in US bonds. Japan too has been reducing its holdings. Even the UK and Germany have started trimming their positions. The reasons range from rising interest rates to political tensions and fears about the US government's ability to manage its massive debt. Despite the sell-offs, US bonds are still widely held, but trust isn't what it used to be. Investors are beginning to ask a once unthinkable question: can the US afford this level of debt? And what exactly would happen if global buyers stopped showing up? Let's break it down in the next section. If foreign investors stop buying US debt, the impact would be immediate and serious. Currently, the US pays over $3 billion per day in interest alone, more than it spends on national defense. Over the next decade, every American could owe over $40,000 just in interest payments. That's money that could have gone to healthcare, education, or social security. If more countries begin selling off US debt, it could trigger a massive bond sell-off. That would flood the market with treasuries, driving prices down and interest rates even higher. So first, this will push interest rates higher. We're already seeing early signs of this. In early 2025, the 10-year Treasury yield rose from 3.9% to 4.5%, the highest since February. That spike signals rising borrowing costs across the board. Higher bond yields mean mortgages, car loans, and business credit all become more expensive. This would slow down business activity, bring unemployment, and increase the risk of a full-blown recession. In March 2025, a 10-year Treasury bond auction went uncovered. That means not enough buyers showed up. For a country like the US, that's a major red flag. When this happens, the Federal Reserve often steps in to buy the excess bonds. But that means creating new money, which can fuel inflation. And that's another problem. If prices go up faster than the money made from bonds, investors lose value. For example, in 2022, 10-year bonds gave only 1.5% interest, but inflation was over 7%, so investors lost about 5.5% of their money's real value. That's why many investors are now choosing other options like gold, foreign bonds, or different currencies. Second, if many investors sell US bonds at once, it would weaken the US dollar. When countries sell treasuries, they also get rid of dollars. 2 decades ago, dollars made up over 70% of global reserves. Today, it's under 55%. Countries like China, Russia, and Brazil are moving away from the dollar and building their financial systems. And when countries dump US debt, they also sell off dollars. This weakens the dollar's value. A weaker dollar will make imports more expensive. Considering the US imports nearly $4 trillion worth of goods every year, 25% of all manufactured goods, and 20% of its food supply. That means inflation could hit everyday essentials. Higher prices for gas, groceries, electronics, medicine, and much more. There's even historical proof of how damaging this can be. Venezuela once borrowed heavily during its oil boom. But when oil prices collapsed and foreign lenders pulled out, its currency crashed. Inflation soared above 100%, and basic items became unaffordable. The US isn't Venezuela, but the fallout from a US debt crisis would be felt across the entire global economy. But it's not just America that feels the shock. The US Treasury market is like the anchor of the global financial system. It's everyone's problem, and if the most trusted economy wobbles, the entire world will. It would trigger a global domino effect. Many countries, especially developing nations, hold US dollars and treasury bonds as part of their foreign reserves. These assets help stabilize local currencies and provide confidence in their economies. But if the value or trust in US debt collapses, those reserves would lose value. That could lead to a local currency crisis, rising inflation, and a slowdown in foreign investment, particularly in regions like Africa, Latin America, and Southeast Asia that rely heavily on dollar-based trade and loans. This would also shake global financial markets. Investors would likely pull money out of dollar-backed assets, creating volatility and disrupting international trade flows. Stock markets around the world could take a hit. Even America's allies would feel the shockwaves. There's also a risk of a shift in global economic power. Some nations might try to reduce their reliance on the US dollar, turning instead to alternatives like the euro or the Chinese yuan. As of 2024, about 24% of international reserves are held in euros and just 2.3% in yuan, according to the IMF. But while these currencies are growing in usage, they still lack the global trust, liquidity, and infrastructure that the US dollar has built over decades. We've already seen a glimpse of what panic over US debt can look like. In 2013, during the taper tantrum, the US Federal Reserve merely announced it would slow down its bond purchases. The result? Currencies in countries like India, Brazil, and Indonesia dropped sharply, and borrowing costs surged. And that was just a slight policy shift, not a full halt in foreign purchases of US debt. The world remains tightly linked to the US financial system. So imagine what would happen if foreign buyers completely pulled out. That's where we turn next. Can the US survive without foreign buyers? Let's be honest, if the world suddenly stopped buying US debt, it wouldn't be the end of the world overnight. But it wouldn't be easy, and it wouldn't come without consequences. Right now, the US government owes over $34 trillion in total debt. Out of this, about $8 trillion is held by foreign countries. If these countries stop buying or even start selling off US treasuries, the government would need to find new buyers quickly to keep funding its operations. One possible solution is turning to domestic buyers, such as US banks, pension funds, and individual investors. These groups already hold a large portion of the debt. For example, as of 2024, US investors hold about 70% of newly issued Treasury securities. But it's unrealistic to think they can take on all the demand foreign buyers left behind. There's only so much money available in the system. The Federal Reserve could step in and buy more US debt. This happened during the COVID-19 pandemic, when the Fed bought $2.7 trillion worth of treasuries in 2020 to help stabilize the economy. However, if the Fed kept doing this on a large scale without strong economic growth, it could lead to higher inflation. There's also the option of cutting government spending or raising taxes to reduce the need for borrowing, but this is politically difficult. Programs like Social Security, Medicare, and defense take up huge parts of the federal budget. Cutting these would be unpopular and take years to implement. In the long run, if trust in US debt drops too much, it could lead to a credit rating downgrade, like what happened in 2011 when Standard & Poor's downgraded the US from AAA to AA+. That caused market panic and higher borrowing costs. So, can the US survive without foreign debt buyers? Technically, yes, but it would mean big sacrifices, slower growth, and serious economic adjustments. The US depends heavily on global trust. Losing that trust would come at a high cost. And the clock is ticking. So what do you think? Would we be heading toward the end of the US dollar's dominance? Or will America adapt and stay on top? Thanks for watching, and we will see you in the next one.